Well, good afternoon, investors. Hopefully you're having a nice, warm holiday season curled up by the fireplace. There's pretty nasty weather still in many parts of the United States, and Michigan is no exception. It's a bit chilly. It's a little less chilly than it has been. The market has been downright frigid for the last several months, so we'll talk about that a little bit. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, and I'm joined here by dear colleague Ken Kavula. Good afternoon, Ken.
Good afternoon, Mark. I hope you're doing all the things that you're supposed to do during Christmas. You have three grandchildren of an age that, if I had to pick my most favorite age, somewhere around 3 to somewhere around 12 is my most favorite age, and you got three boys right in that sweet spot right now.
Well, some of the people in the audience have seen the pictures of me in my plaid pajamas. Along with the grandson, so they know what I'm talking about. I will spare you and the rest of the audience the picture, but we do a pretty good job with them on Christmas Day, and my wife does a spectacular job with very specialized, customized gifts for them, and I just need to get her involved here with picking a few more stocks because she's pretty good at that too. All right, so we're going to go over a few things. I do want to spend just a little more of a dabble with our dromedaries. Yes, that is a camel on the far lower right, Ken, along with some of the other creatures around the manger. And we'll talk a little bit about 2022, and it's been kind of a strange year, not as bad as it probably should seem for many of us. Our core holdings have held up fairly decent as a community, and we've had some pretty decent success with some of our special situations too. So that's all part of it too. And I do want to spend a couple moments with a couple of our favorite slides here today that I think, and Ken, I think you agree, kind of address that fear aspect, especially for somebody that's relatively new to investing. If you can learn to put your head down, find an excellent company, and wait for it to be on sale, that can be most rewarding over the long term, and that is fun without any question. All right, so some of the other themes of the year, Jerome Powell has definitely made a difference here in the last half of the year as inflation took off and they're trying to battle that. That is an image of a Russian tank in the banner there. At least I'm assured it's a Russian tank. I could be wrong. Somebody will probably correct me. But that has been quite a situation. And again, we just want to celebrate a little bit of long-term perspective. You will notice, Ken, that the Twitter birds have snuck in on the doves.
On the two calling birds. Uh-huh.
All right, so let's go ahead and get underway. Here's our standard disclaimer. No investment recommendation is intended. Again, this is an educational demonstration with emphasis on the word demonstration. We are here to illustrate some methods, techniques, philosophies, beliefs on how to discover an opportunity and how to analyze that opportunity to the extent that you build a portfolio and manage it. It's all based on the lessons learned for now over 8 decades with the Modern Investment Club movement. So that's what we're going to be sharing, our opinions and our interpretations of that. So you will hear opinions from us. Please do your own homework, do your own review of any company of interest before you make a decision. We might own some of the companies. We try to remember to acknowledge that. We do have a roundtable tonight, so this will be a bit of a truncated session. Our monthly webcast known as the Roundtable is just simply meant to share 3 or 4, maybe 5 ideas going back all the way to 2010. We'll talk more about that in a minute. If you want to have a reminder about those monthly sessions, send an email to nkabula1@comcast.net, and we'll let you know. And if you have anything else on your mind, our 2 email addresses are right there. Anything else you want to add, sir?
Nope. You covered it quite thoroughly, Mark, so let's get going.
Yeah,
Here we are.
All right, we are going to spend some time with our 12 favorite stocks at this time, at least 12 that passed a bit of muster. And we do want to talk about the previous year and the importance of rolling. The used car salespeople is a reference to car gurus in a letter we received from an investment club. And Ken, I think I'm allowed to present the best small company update, at least a quarterly update at this time.
Yeah, it looks pretty good right now, so you can show it, but we don't want to spend too much time on it. We still got a long time to go before we take the prize for this year.
Well, one area we don't have a lot of time is 1 month and a week remaining in the Groundhog Challenge, and we'll take a look at that as we always do. I do want to update the audience on which of the Barron's best ended up as the ones that you guys selected as the least likely to succeed the next year, and then we will share the 12 stocks for our 2022. It's actually 2023. That's a typo. Countdown. Well, here's kind of the theme for this past year. The Wall Street Journal talked about in this tone, and we see this a lot from the institutional press, basically picking on individual investors a little bit while the pros do some selling and some crazy stuff. Did you catch this article, Ken?
I didn't, Mark, but I have noticed that this tone is almost everywhere the last couple of weeks. That there never a chance goes by to take a snide comment about the individual investor and how they're clueless a lot of times, and how they are doing all the wrong things, and they should be climbing on the wagon of the folks that are losing 50 and 60% right now. So
Well,
I'm satisfied with what I'm doing individually, and I'm all the more convinced after going through yet another bear market that I can handle things just as well as some of these pros can handle things.
yeah, it is a matter of perspective. And last week, after you had mentioned that Josh Brown, the reform broker, had made some comments about Jerome Powell and the Fed and all that kind of stuff, I actually checked in on one of their podcasts or webcasts or whatever, and they were talking about this article. And and Josh Brown, I mean, we've spent some time with Josh Brown. We love some of the stuff he does, but Josh basically pointed out that he's on our side on this one, Ken. There's a section in this article that talks about an investor by the name of Wilkinson in Nashville, and he's talking about the longer term perspective, hanging in there, and all that kind of stuff. And Josh basically just lambasts the press, saying he's probably the only one in this column that's getting it right, and he defends Wilkinson, and they're trying to basically pick or make fun of him. And Josh points out that, again, long-term perspective, have some conviction is a pretty good thing. So I'll probably grab excerpts from that and put it on certainly in the forum thread for people that want to grab that, and I'll link to the Wall Street Journal article for those that have this subscription.
I'd love to see us talk a little bit also, Mark, about tax harvesting at the end of the year, because I've watched a couple of clubs, not only two of them that I belong to, but three or four others that have invited me in the last month or so. I've watched them go to extremes on tax harvesting. I mean, tax harvesting doesn't mean go through your entire portfolio, find every loser and sell it. I would like to talk a little bit about what the rule is, and a little bit about how you can do it in a sane way without creating all kinds of holes in your portfolio, which you then, by the way, have to turn around and fill at some point if you're going to stay relatively fully invested.
Yeah, it's get kind of late in the year for too much detail, but we could dig in a little bit deeper to that. I mean, I have never obsessed over it because, first of all, the statutory limits on how much you can actually harvest is not that large. So you can get carried away pretty quickly if you don't watch what you're doing.
Well, and especially if you have a reasonable sized portfolio,
Mm-hmm.
So I'm not thinking of it for necessarily for education for this year, but I'm thinking about maybe something we could talk about as we approach August or September for next year, give people lots of notice about it and everything.
Okay, no, that makes a lot of sense, especially since we now have the September, soon to be known as the August effect for what used to be the January effect. So,
Exactly. It's moved way back. Uh-huh.
all right. So with that, let's talk a little bit about the year that was. Lynn Douglas is here with us. I don't think he's got audio equipment today, or he would have joined us online. But Lynn was one of the lone voices in the wilderness a year ago, talking about um, the pressures that were coming to bear on petroleum pricing and all that kind of stuff, and the way that that really interferes with the economy. And he basically put forth a pretty simple reality in that a barrel of oil doesn't just go into the tanks of automobiles and trucks. And awesome slide here. And his whole point is, yeah, it's going to have cycles, it's going to have economic cycles, but over the long term, there's more to what happens with petroleum than, again, the gasoline that's in tanks. And no matter what happens with electric vehicles, this will be true to some extent. It will change, it will modify and revise and evolve over time, but a lot of stuff is produced from petroleum products. So his old pitch was find some really good companies and go with them and hang in there with them. Warren Buffett agreed, by the way, with his purchases of Occidental and Chevron. And of course, the graphic on the lower right is just the reality that inflation has been a big part of what's going on. Now, I
Well,
don't own much when it comes to energy stocks. How about you, Ken?
well, Mark, is this sort of like a confessional if I tell people it's going to be kept secret? Because it certainly is something that you can't do a traditional analysis on using the tools that I work with, at least. So if I owe up to owning two different companies in oil, will that be okay? You know?
I'm not going to tell you that your secret's safe with me if that's what you're asking.
I I did buy some Exxon Mobil about 14 months ago, and I bought some Devon Energy about, I want to know, 10, 11 months ago, and they both done extremely well. I don't know how much longer I'm going to keep them. I'm not in the habit of buying a stock and then considering it for sale a year, year and a half after I've bought it. But I listened very carefully to what we had to say, what Len had to say, what some other people that I respect had to say about energy, and thought to myself, the last time there was this big pull on energy, I stayed completely away from it and missed every single profit that was to be made in energy. This time I wanted it to be different. It is different, and now I have to decide what I'm going to do with the profits that are sitting. Luckily, one of them is in a tax-free account, so I can sell it without worrying too much about it. But one of them sits on this side of the tax barrier, so I'll have to grit my teeth and deal with a capital gain, and then figure out where I'm going to go next with that cash. But I do own two at the moment, Mark.
All right. Well, while we're opening kimonos, um, try not to focus on that image too much. Um, the one stock that I do have that's in a related area that has been greatly disappointing for quite some time is Schlumberger. I think that they're an awesome company in that business, serving that sector basically. But it has not been, I mean, it's not a big loser or anything, but it's certainly not any type of a sexy return over the long term. So that is the one that I have, continue to have. All right, the other big highlight uh, was simply this one. A year ago at this time, they were lining up soldiers and tanks on the Ukrainian border. And as one pundit said in that Josh Brown panel session, by the way, they weren't lining up to take pictures. Um, yeah, that this is one of the bigger geopolitical forces that can mess with the stock market. and individual stock prices. And it's been pretty hard to ignore what's going on in this neck of the woods. Hopefully, this isn't too close to your family's home turf, Ken.
Well, it actually is. My entire father's side of my family comes from Slovakia, and that little carve out there going towards Kiev is Slovakia. For those of you that aren't up on your European geography,
So right,
and
right up in here, you mean?
no, down south
Oh, down here.
west, so down in there, and
Okay,
that whole carve out right there is
sure.
Slovakia, and there's a mountain range right there, so that's what makes it a natural border. But the village that my family's from and that we have lots and lots of cousins in is about 45 or 50 miles from the Ukrainian border through the mountains. So it's not easy to go directly over the mountains to get to the Ukraine, but the family is very, very close to that area.
Mm.
That's why Slovakia doesn't have a lot of refugees coming in right now, because of the mountains.
Tough to get there.
The easiest way to go is to go to Poland over the plains, up by Lviv, up in the north west corner or northwest side of the country there.
All right. So obviously, major force in the last year.
Yeah.
Um, Anything else on that one, Ken?
No, unless you owned EPAM systems, a favorite of the community, and I'll tell you, I hope you had the temerity and the courage to listen to the folks from EPAM when the war began, and to listen how committed they were to, first of all, honoring all their contracts, and second of all, doing all they could to help their employees. Many of them that lived in Ukraine, many of them that they helped out of the country or helped get to relatively safe places in the country. EPAM took a real hit. If you had a lot of conviction, you bought a lot more of it, as my Wolves Investment Club did. We almost doubled down on that stock when the war began, and we've been extremely pleased because it's come roaring back as it fills the contracts and as it brings its people back online, and then goes out to other parts of the world and hires enough people to do the contract work it needs done. So if you owned EPAM, this was a real big impactor of the price of that stock, and so far the story has been quite good on the recovery.
Yeah, unfortunately, we did take it out of the 10 cup portfolio, but I basically listened too closely to the rhinos, I think. I should have listened to the wolves.
Yeah. We're getting a question from Yuval. He says, when I say all invested, does that mean 100% at any given time? Yuval, no. I keep cash accounts. I'm retired and old, and I keep cash accounts to pay various things, and I do own some bonds. It means that I'm staying 100% committed to my investment plan. I did say 100% invested, and that's not exactly what I meant, and I apologize for that.
Okay. Matt Spielman, who's really not able to join us. If he is, he doesn't have audio equipment today. But one of the things that he pointed out as kind of a major shifting of the tides was what happened with Facebook, now known as Meta, back in January and February. Kind of set the tone for many of the NASDAQ type companies, and it's kind of hard to ignore. And his whole at least thesis to at least be aware and be watchful lines up with our session on life after Google, Ken.
Yep, absolutely.
This was pretty extreme. I had forgotten how significant that 1 day drop was. Largest
Mark,
1 day loss ever.
can you remember? Go back one slide if you could, Mark. Can you remember another company that had this short a distance between overbought and oversold? I'm looking at the RSI up there peaking above the 70%, and then peaking below the 70%, and my goodness, that can't be more than what, about maybe 12 months at the worst?
Not to the extreme that it is, especially since it got down to
Yeah.
20. It went from 80 to 20.
Yeah. So, I mean, that's really quite a, I just can't in my mind think of another, especially a stock that was owned by a significant portion of the population, doing something like this in such a short time.
And it's still very widely held, especially institutionally.
Yep,
And
no doubt about it.
stuff I will take an I told you so bow. Wendy and I sold right there. I can show you the brokerage statement. So we actually exited this company just because didn't care for some of the testimony and some of the stuff going on, and we could have been just as wrong as could be. But Wendy had this from the date of the IPO. I think you remember the day, Ken, because I tried to talk
Uh,
her out. I tried to talk her out of it.
Natalie and I exited the stock when we rebalanced at the beginning of, or at the very end of 2021, going into 2022. So we've been out of it now for about a year. We didn't grab the high like you did, but we did sell it somewhere near 300. We sold maybe a little bit more than that, but it's just dramatic,
It
just
is. It
dramatic.
is without a doubt quite dramatic, and that was a big moment. And it is worth noting they are still trying to find their footing. They very well could with the meta stuff, but kind of a tough year. Now I can't explain this one, Ken. This one just keeps showing up. It makes it into our slides for the round table.
I don't know if you're going to want to keep having this one show up, Mark. It doesn't appear to be doing as well as it might be doing in our small company list here.
You see, Ken,
So
it's got to catch fire. So
we're going to have to send you out to buy some of that stuff on a regular basis,
well,
and then your
Wendy's,
wife's going to be angry at you for eating fast food on a regular basis. So,
well, Wendy's in Chicago right now, so she can pick some up for us.
all right.
She'll swing by and see Kevin. Maybe buy some for Galogly while he's in Chicago. All right. The other thing, that major stock market moment in 2022, our 7-year winning streak came to an end.
Yeah,
For the
I don't
best
think it made the national news, Mark.
well,
Okay.
well, it should have. And yeah, it was our first year. We had seven beats in a row. And again, the context here is that it's 1 year. 1 year really doesn't mean that much. It's uh, inevitable from my perspective that this is going to happen, and it did. But we're still 6 percentage points better than the total stock market, Wilshire 5000. So we just keep pressing on. We are back on the pumpkin.
And it's the best argument, Mark, for long-term investing, not for investing that you focus on 10 months or 12 months or something like that. It's one of the best advertisements for let's focus on 3 and 4 and 5 and 6 year groups of gains that are all together rather than on a single year.
Having said that, I did want that 10 or 12-year streak. So,
Well, I know you just wanted to be able to wear a lapel pin. So
all right, here's our context. Again, we lock in at that green bar as we're at the end of the fourth quarter. Jerome Powell and the interest rate increases have had something to do with this. But again, the long-term perspective, we believe that the green bars will chase the blue line. The blue line is nothing more than a regression through those green bars over time. The red is basically the average return forecast, if you want to think of it that way, for the stocks in the value line standard edition. So they float around. They're actually back at 14.2%, which is basically suggesting that there's a few more stocks on sale than there were at the beginning of December. So We'll probably stop putting Jerome Powell on the pictures sometime soon. That would be my guess, anyhow. Any
Well,
thoughts?
I hope that's because he's decided to slow down the amount of interest raises and maybe pause for a little bit of time to give what he's already done the chance to take effect. So I hope that's the reason that we'll kind of eliminate his picture from some of the graphs.
There are people that believe that there will be some moderation in the not too distant future. Time will tell. All right, so let's go through these again. I mean, one of the reasons we put that other slide up there, this one, is for the long-term perspective. Now, again, this goes back to 1999, so it is truly a long-term perspective. Here's another long-term perspective going all the way back to 1928. These are annual returns for the S&P 500. I think they had to do a little bit of iterative calculations to get back that far, because I'm pretty sure the S&P 500 hasn't existed that long. And my policy in almost everything that I do is to ignore anything below this line. So anything before 1941 basically is the wild, wild west. It's back in the days before Benjamin Graham wrote security analysis. It's before many of the laws and regulatory considerations in the investing world even existed. So I start any analysis going forward from 1942. So if you want to go ahead and plop all of this noise here, which was a mess, onto any of the charts, you're certainly welcome to do so. But I think it really is two different rodeos going on there, pre 1942 and post 1942.
Mark, what's your guess as to when the S&P actually begins? I'm thinking early 50s. Am I right?
Something like that. I'm sure Ted Brooks knows.
Okay. All right.
I'm sure it's been covered in a forum, but I don't remember exactly when. So something
I
like
think the thing that compels me more than anything else when I look at charts like this is to look at times when I've actually been investing and remind myself how bad the current one feels, and then look back at what some other ones were and say to myself, maybe it's not as bad as I thought it was. Look at 2022, folks, and then look at 2008. And when 2008 can come up there as three times, rounding off a little bit, 2.5 times what 2022 is, maybe this isn't as terrible as we've been led to believe. Look at 2002. That one doesn't even stick in my mind as being a particularly bad year. Does it stick in your mind, Mark?
just that it gave us kind of an unprecedented moment in some of the longer term charts. We'll actually show one in here in a minute. But keep in mind that these 3 years here came on the heels of these five.
Exactly.
And boy, these five set the table for those three in a way that made them, on most graphs, fairly insignificant. And my career basically starts, somewhere in here in terms of earning money post college, and pretty good decade after that. And my work with the National Association of Investors started in the early 1990s. So this was a golden age. There's no doubt about it. So it's been kind of fun. You could also argue that this here is pretty much a golden age too, after the
Well, and
moments.
And the 3 years before this year really set us up pretty well too. That people forget how good 2021 was. All they can do is weep about 2022,
Mm-hmm.
and yet we've lost just about half of what we had in 2021. That's if all you did was made 14% each year, maybe you'd be a little bit happier than if you make 28 and a half and then lose 13.8. I don't know. But my investing career goes back to I owned my first stock. I first talked to a stockbroker in 1974. So that's I go back to that point.
That
And
was a rough moment.
It was a rough October in 1974, an absolutely terrible October. And that was where my wife came into a list of stocks from her father's passing that uh, had lost somewhere around 40% of their value in the period of about 2 weeks.
Wow.
So it was a real rough time. Uh-huh.
Right. So the way Ken likes to look at this is better shown right here. So I'll let you expound poetic here, Ken.
Well, these are 1 year returns, right, Mark?
Mm-hmm.
So you just slap them up on a graph. You can change the bottom if you want and make it go by fives. You can make it go by tens. I wouldn't recommend anything larger than tens like we have here. But if you want to go by fives, I've seen the graph go by fives and it relatively looks pretty much the same. But I think I'm looking at something, it's not exactly a normal curve, but it's certainly approaching a normal curve. And what impresses me is that the height, the top values aren't 0 to 10, as you might expect, or -5 to +5 as you might expect, but they're in the 10 to 20 range. That's the most prevalent return, the median, if you will, for this set of values, sitting up there at that highest, the highest bar on the histogram. So it also points out to me that the negative side of the market happens much less frequently than the positive side does. That plays to my natural tendency to be an optimist in the first place. So I like that a lot. What I like even more, however, is when you put these on a graph, and instead of showing 1 year periods, you show 5 year periods, so that if I look at 2022 on a 5 year graph, and Mark's displayed it a little bit differently, I notice that there's virtually no negative values coming up. In any given 5 years, and I think this one goes from the mid 80s, that's good. But in any given 5 years from the mid 80s, there's only one period where you actually would have lost money in the stock market if you're going to stay relatively fully invested, and if you're going to not play around and be out of the market for large periods of time. So I like this kind of analysis of statistics. Statistics have always been something that you can play with. I think Mark's colored green the years that follow a down year. So we thought there might be something to the idea that after a down year, you're more prevalent to have an up year, and that's certainly true. Make sure that you start at where 0 is. That's not the top bar. That's the one to the left a little bit. But most of the green is going to the right of the 0 point, which means that in most years following a down year, you have an up year. And sometimes you have extremely big up years. I mean, look, there's 5 of them in the 30 to 60% set of bars. And if you go from 20% on up, you're talking about 10 of them. So I think that is just another idea. We've already talked a couple of bull sessions ago about how the year after a midterm election has never seen a negative growth number since after World War II. And so you start looking at some of these different predictors and say to yourself, we might be in for a pretty decent year next year as things are moving towards, Powell seems to be maybe moving towards stopping some of the interest rate increases. Inflation's moving in the right direction. I still don't think interest rates are something that's going to kill the entire economy, although some of the Gen Zs and the millennials might disagree with me violently. I've watched us live through 3, 4, 5% increases in interest before and be perfectly happy with the whole thing. You know, you can actually buy a house at 6% interest and maybe still make it through the end of the 30-year mortgage. So
I can
I'm
remember
just
drooling.
smiling. I'm just smiling. That's all.
I can remember drooling over my mom and dad's 5.5% mortgage. So
Yep, yep.
that
Just
was
smiling.
that's certainly a reality. The only thing that really does kind of jump here is when it has gone bad, it's not been pleasant. Back in 73, 74, and 2001, 2002, the succeeding year after a loss was substantially negative, and that is possible at this time. But I kind of like what Ken was pointing out. We also still have 4 days for this one to move from here to here. So
Yeah, we have George out in our audience telling us that the S&P 500 came into existence in March 57,
okay.
March of 1957, March 4th to be exact, and that's the index mark that came originally from the original S&P stock index, but I don't think it contained 500 stocks if I'm reading George's note
Mm-hmm.
correctly. Okay.
So it's approximately as old as I am. Approximately.
Yep. Yep. We're getting questions from a couple of folks. Do we ever try to adjust for inflation on these numbers? No. It's this being market statisticians is not our job, but I will tell you that if you do some internet searching, you can find extremely interesting sets of numbers on almost anything you want to search for. I will tell you that a great source for graphs and numbers is the St. Louis Fed.
Yep.
They have people there that really like to put this kind of data in pictorial form. So I would turn it back to you and say, there's a good thing for you to do. And if you find it and want to share it with us, send us the link and we'll put it up in a bull session and talk about it at some point.
Absolutely. All right. Here's just basically some reinforcement. It's kind of the Jeopardy moment. The answer is 10.8. The question is, what is the average 5-year annualized return during this time frame, which again is not anything to shrug about. This is 4 decades. And as Ken has already pointed out, we did have that rather special and painful moment when the 5-year return went negative back in 2008, but that's really been kind of an exceptional moment. So think 11%, like Ken always talks about. All right. Well, Ken, this one kind of erupted accidentally. I've got this place where I keep track of, you know, indexes and various portfolios, and in this case, individual stocks from certain dates back. Many of these revolve around the time when I first became interested in investing, and the Tin Cup portfolio actually dates back to the end of 1994. But for me, Ken, this is the answer to why invest in stocks. You know, why try to find excellent companies trading at exceptional return forecasts? And I think that's the answer to the question. I mean, this is. I think we could spend an hour talking about this page. What are your
Well,
thoughts?
I told you before we started, Mark, that we're looking at my biggest holding, my second biggest holding, my third biggest holding, my fifth biggest holding, and my sixth biggest holding in the top 5 stocks that are sitting there. I would imagine that most successful, better investors are holding 3 or 4 of these stocks in their personal portfolios, maybe holding all 5 like I am.
Yeah, those top 5 are the 5 most widely followed companies by Manifest Investing subscribers, so they appear all over the time in portfolios. And the Tin Cup portfolio goes back to 1994. That annualized total return, 16%. That's nothing to sneeze at. And of course, the roundtable, which again meets tonight, a little bit shorter time frame, but still over 10 years, 14.4%. Um, and when you start getting, 2, 3, 5, 7, 8% better, percentage points better than the stock market over these periods of time, you're talking about a whole lot of incremental dollars that are just kind of massive. The one that I included on here because I think it's really kind of cool. Neogen is a bit of a Michigan uh, community stock, if you will. I mean, it's nationwide now, but many investment clubs in the state of Michigan know about Neogen as a small startup company out of Lansing, Michigan. And what is fascinating is in a year where they have dropped nearly 70% year to date, they still have this for a multi-decade annualized total return. And to me, that's
Mark,
suggesting. Go ahead, Ken.
I'm not going to challenge the number, but I'm just going to ask, did you include the split in the last year on Neogen?
I'm certain that I did. I mean,
Okay, all right.
unless
Okay.
stock charts missed it.
Okay, that's fine. No, I didn't realize it had gone down quite that much during the year, but again, I don't obsess over what I own, and I don't. That's the sixth one that I own on the list, and I'm glad that it's staying ahead of the market. I didn't realize it had dropped that much.
But the thing is, you drop that much and still have that type of a long-term return. That's pretty special. So the other thing to take note of is, a lot of people out there are index investors, and that's fine for a lot of people. But the index mutual funds that are based on the Nasdaq or the S&P 500 or the Wilshire 5000, you can see where they end up. And within the last calendar year, we celebrated the long-term outperformance of the medium-sized companies, and it shows up right there in black and white. And the value line arithmetic average for the aggregate investments on this list being up at the top again is reinforcement that all of the above investing works. And then the two Coca-Colas is kind of an interesting thing. Buffett is renowned for coming into the train wreck that was the new Coca-Cola back in the mid 1980s and the divestiture of the motion picture studio, taking a large position in Coca-Cola in the late 1980s, having a decent return. But 15 years before that, Mr. Nicholson, in his demonstration of the triple play, basically advocated for that particular company. And between then and now, you're looking at a pretty nice return there also. So like I say, I think we could talk lessons for an hour here about a variety of things. But again, why do we get out there and try to find excellent companies and buy them when they're on sale? I think this answers the question.
Yeah, and this is the reason also that uh, keeping track of your portfolio in a piece of software that can actually tell you performance, including dividend, over a period of time. Those kind of records are important for you to actually measure if you're doing as well as you think you're doing. That's why there's so much report writing that can be done in our club's accounting systems. And that's why I've always recommended that you find a great piece of software and then you follow your portfolios. If you do it on a monthly or even once every other month basis, it's not a lot of work. It is a lot of work if you haven't been doing it for the last 20 years and you want to get started, because you want to go back and try to recreate as much of your history as you can. But these are all date sensitive. So those numbers at the top of the column, those of the first 5 stocks there, would probably be very different depending on what your holding actually was and when it began. So Mark, these are beginning when they were brought into the manifest, or when they were first public, or when are they beginning?
It's basically going back to first mentions in the community, that type of thing. They're not
Okay.
all the way back to day one, obviously, for these companies, but
Okay. Because the only one that I'm certain that I've owned longer than this is Cognizant, and I know that I've owned Cognizant longer than from '98 on.
mhm.
So yeah.
Yeah, it's just good, clean fun and a reminder while we scratch our heads and do this the type of stuff that we do. And it sets the table for this one, which is another moment for at least for me. So indulge me, everybody. From 2022, we actually made this discovery as we were talking about long-term performance. Again, our roundtable is based on sharing 3, 4, or 5 ideas per month since 2010. So that's a total of about 700 selections. And if you go back and actually look at the performance logs, we discovered that approximately 30% of the selections have uh, either ending or current values less than the original $1,000 invested into them back at the time the decision was made. So some of those are realized losses, others are unrealized losses, but that total actually adds up to 61,300. This is as of a few months ago. And then we just simply make the rather, at least for me, the rather stunning observation that we have picked Microsoft 5 times over during that 10-year period, um, most of them back in that 6, 8, or 10-year time frame. And the gains on that $5,000 investment more than offset the loss of those over 200 companies, or 200 positions, I should say. And if this doesn't take uh, and basically extract fear and put it out on the front porch, it really should. It's something that I think anybody who watches the madness and craziness that we do, as we're accused of it regularly, that you can't be doing that, that can't be happening. Buffett gets accused of the same thing, but this is happening, and it's really it's really great to be along for the ride.
Yeah, I know this takes a little bit of time to put this particular set of numbers together, but maybe we can do this again in the springtime, Mark, and see if this is still holding, because this is so powerful to show to almost anybody, and it's so easily understood that one stock is balancing out the losses from 222. Um, so if we could, I'd be glad to take Solomon at some point and add a couple of Kavula columns and uh, come up with the numbers and then throw the spreadsheet away and just display the numbers. So I'd love to do this every 6 months or at least once a year just to show that this is happening, because I'm certain it's going to continue to happen.
Yeah, it's going to happen in some flavor, even if it changes
Yeah.
slightly.
I mean, even Mark, if you have to pick the top 3 gainers to balance out all your losses, we know that we have a heck of a lot more than 3 gainers in that portfolio.
mm-hmm. Good, clean fun. All right, this one's kind of a this is the type of slide, at least from my perspective, is one that the rhinos, the institutional analysts, use to frighten people and basically make situations seem very precedented and very ominous at times. And what you're looking at here is 20% declines going back since World War II. So it fits my description of fairly legitimate data. You can see the pandemic was very, very unique in how fast that one happened. And we are currently in the middle of this one. I like this one, Ken, because it shows the rally that we had towards the end of last year. And I don't know, it just resonates for me with we've sort of seen this movie before. Your thoughts?
Well, my thoughts are that for those of you that think you've gone through the worst period in investing that's ever existed, check out all those low points that are lower than where 2022 is. I mean, 61 and 87 in 2007 and 68 and 73 in 2080, all of them, were a little bit worse or much, much worse than we've seen thus far. Now, granted, the red line isn't finished being drawn. So we'll kind of watch this picture, and maybe when somebody finally declares that we have seen the bottom and it's moving the other way, because there will be a declaration at some point that the bottom has been reached. When that happens, then maybe we'll display this graph again. But at the moment, what might seem like something that is just terrible to people that have been investing for a relatively short amount of time, to those of us that have gray hair or no hair and have more than 60 years under our belts, maybe times aren't quite as bad as they appear if you're looking at it from a younger person's perspective.
Well said. All right. Just a quick moment. One of the things that's made my year interesting, if nothing else, I promised the audience that we will come back and take a look at this, and we will. This is actually from the Manifest Forum. I have tinkered with some long-term options, and so we will dedicate a future session to this, but this is the status so far. I mean, 7 for 7. I do have some right now that are in red ink, thanks to the performance of the NASDAQ, but want to come back and take a look at this in greater detail along with some of the driving force behind it. It's not for core investing. It is speculation. However, my speculative play area has more than offset some of the core stuff this past year. So I do want to spend a little bit of time with it. And here's just one other point that I've always kind of wondered about. You saw what happened with Facebook back in January and February. It's not confined to Facebook. The NASDAQ 100 has suffered the entire calendar year. And I thought to myself, I don't think I've seen this presented anywhere else. What if I could perhaps add one more bullet point to trying to develop a discipline for doing this sort of tinkering, or you can call it hedging, whatever you want to think about it, for special situations. What I've done on the bottom here is I've taken the volume on the TQQQs, which are triple leveraged QQQ. It's an exchange traded fund, and basically compared the net to the amount of short on the same thing. So it's a triple leveraged short. So basically the SQQQs are people, and for the most part, these are going to be institutions and rhinos betting against the market. I just want to get a feel for what are they thinking? What are they actually doing with their money? And this number has run anywhere from 80 to 100% historically. And with that Facebook moment that we talked about a few minutes ago, we basically got to here. And it has not recovered. And
Mark, I know that you're pointing. It just showed up. Okay. Can you back up again? You said it got to 80% or to here when you were the arrow just appeared on the screen.
Yeah, if you go back into 2021 and 2020, this number goes up and it stays in the 80 to 100 range that entire time frame. So you basically have most of the institutional rhinos going with the long version, the TQQQs. Historically, we had never seen anything where it dropped below 50. Okay, so that actually happened at the time of the Facebook moment, and it has not recovered. I did my tinkering around in this time frame last summer when I talked about the tequila trifecta, and then we had the rally towards the end of the year. But what this is suggesting, and again, I'm not saying they're right. I'm just saying this is where they apparently are from a sentiment or an attitudinal perspective. They are still quite negative on the prospects for the NASDAQ 100 stocks. And I mean, you look here, you basically have a couple situations where there were more people short or betting against the stocks than long. It's just amazing. So so something I want to watch as part of building a discipline. And again, we'll cover this in greater detail. Your camels are back, Ken. You
We
can
need
see
a line technology, Mark.
this. They do need a line. All right. I don't want to cover these in any great detail. A club sent us basically the commentary that the return forecast for Car Gurus, one of our best small companies for last year, was quite turbulent, kind of a bumpy ride. That's even pretty stiff for a roller coaster. And basically, we took and answered this in some way by pointing out the limited track record. Again, you don't have revenues going back farther than 2017. You also have a relatively low number of analysts covering this type of a company. It's just something you want to be aware of when you're investing in a company like this. Today, I want to take it just a little step further, just to kind of put the icing on the cake and point out another element of, what does uncertainty really look like? And here it is. For 2023 and 2024, you're talking about basically a company expected to generate 1.4 to 1.7 billion in sales. And the standard deviation, think of it as the plus or minus for these type of projections or estimates, is pretty large, really, when you look at it. And so for some context with respect to that, basically we're talking about just looking at this one, which is the most stable statistic on this page, right? We're just talking about this one for now. I mean, earnings is even worse. So let's talk about what actually happens to cause the humps in the camel from time to time. And so the upper graph here is the sales history and forecast for Car Gurus. And what you're looking at here is I've drawn in the plus or minus. Maybe this is something we add. I don't know, Ken. Anyhow, the plus or minus for 2023 and 2024, and then basically try to slap a trend analysis on there, just like we do with our stock studies. And I think what you can see here is this fairly significant range of expected outcomes. And when you have a relatively low number of analysts, Ken is always warning you to look out if there's only 1, 2, or 4, or 6 analysts following the company. If any one of them either quits following or changes their mind considerably, it can really dramatically affect the shape of this range. And it can certainly, again, keep in mind that we look at these daily for the companies covered at Manifest, so it can actually jerk the company around with respect to these trends out here. So
I think we could say, Mark, that if we go with the pessimistic viewpoint, the bottom of the bars, then 2022 becomes an outlier.
absolutely. Yeah, and we saw that with a number of companies. Be careful with how you treat the 2021 results, thanks to COVID, and the 22 results, thanks to the recovery and some of the stimulus that was in place. So yeah, it can really move around. The important thing to think about though is what if and I don't know. Be careful if those guys all go out to lunch. All the analysts covering this company all go out to lunch together and all change their minds at the same time. It can also be quite ugly. But contrast that with down here. Okay, same picture. In this case, it's one of those companies that was on that slide a few slides ago. And I think what you can see is there's more information. It's more stable. It's a up straight and parallel type situation. And again, just to make some quick comparisons, those plus or minuses that you see here are nowhere near the magnitude what you saw on the previous page on a percentage basis. And in fact, you could put the high case and the low case, like is shown in the upper graph, and it would both probably fall underneath that single red trend line. So the company Stryker, by the way, some of you have to know that because you're just itching to know.
Let me suggest also, Mark, that a common mistake being made by a lot of folks that are just beginning to deal with the SSG is to draw a trend line on that top graph there and to start their trend line in 2020 because they don't like the data in 2017, 18, and 19. Why don't you just kind of take your magic pen there and draw a trend line through 20, 21, and 22 and show them what happens.
Oh, I
Not
mean,
too hard then.
yeah,
Yeah,
and I have been guilty of this in the past.
yeah.
This trend line right here, you mean, Ken?
Yep, that trend line right there. Uh-huh.
Yeah, you guys have heard the story. I was with a group of nuns in Wheaton, Illinois one day when they drew one of these for Starbucks. This is 20 years ago. They drew one of these for Starbucks, and I said, "All right, ladies, if that actually happens, they will be twice the size of Coca-Cola in less than 10 years. Do you think that's going to happen?" And the answer was, "Well, no." So yeah, you got to be careful with having that happen. And again, we spend at Manifest Investing, we spend a lot of time caring about what this does look like. It doesn't mean they're right, but that is the opinion that is basically deflecting in either direction, positive or negative, these projected trend lines.
Yeah, it's always good advice to tell people just because you can take and eliminate data doesn't mean that the tool is suggesting you should.
No, in fact, I generally try to leave every single year in as much as possible, and then
Right,
work
right.
on the trend line through them all. All right, so that's just again a reason for the bumps in the camel. Here's our quick update on the groundhog. Again, we have about 5 weeks left in the groundhog. Herb Lemkool continues to hover in the individual honors spot, still with 7 digits in his groundhog dollar portfolio. And Ken would like to point out that the Wolves are moving up the list at number 36.
We're up to fourth place in the groups now, Mark. That's good. Okay, but
All
we're
right.
still way behind that monkey.
Yeah, the monkey continues to be annoying, and Kathy Wood continues to be almost wire to wire in last place. Just amazing. All right, our quick update on the best companies we've picked for 2023. It's a good report so far. We don't want to belabor the point. It is acting more like a normal year for us. Portillo's will be back. They'll be fine, Ken. Don't worry. But they are kind of holding up the bottom of this list. The thing that we've done for all of you is we sat down with our top 20 for the year, and we basically decided to leave the rule of 5 losers off the list this year. So it's really you leave those 4 companies that were going to have the worst results off the list, and you can do so much better.
I'll tell you, Mark, what makes me so happy is that we have 2 companies carrying the heavy load and a third one in double digits. That was something we were lacking a lot last year, is anything besides that one company at the top doing any real heavy lifting. So it's nice to see 3 of them in double digits up at the top there. I appreciate that.
And the one thing that we were watching fairly closely, and we highlighted this in previous bull sessions, if you take a look at the value line estimates for sales for 2023 and 2022, in the report that's out this week, it actually has been restored from close to 0 to very close to double digits. So one of the things that we are watching. A week ago,
And we predicted that by with some research, didn't we, Mark?
we did, and then a couple dartboards.
Yep.
Well-deployed dartboards. Here's the 10 stocks picked by Forbes, Barron's for this year. And last week we all voted on which ones we thought would perform the worst in the coming year. So here's the results of that poll, kind of like a coach's poll. 4 points for a first place vote, 2 for a second, 1 for a third. And you can see that we did receive a few people sending emails in and expressing their opinions. And it's Delta Airlines by a nose as the projected worst performer for this group. Those 3 at the bottom are pretty closely put together. Notice that my selection for the worst performer for the year has actually a pretty good performance so far. So
I think that was no, it wasn't Kevin's best worst, was it? Okay,
he was up there. He was number 2.
he was number 2, right? Uh-huh.
Ken, you have managed to avoid the ring of dishonor at this point. So
All right.
So we're not going to obsess over this. We'll come back and check it next December, and it really doesn't matter.
Mike, we have Mike, whoever you are. We have a suggestion from Joe Whitaker out in the audience. He's in the process of reading "The End of the World is Just the Beginning." Joe, could you give us an author on that? And that sounds like an interesting read, and we'll suggest it to our audience, and we'll put it on our reading list if you think it's worthy. Do you have an author on that book, Joe?
It's interesting because I just saved a meme image where the lady basically says, "This is the fourth end of the world situation that I've survived in the last few years." We'll share that with the audience next week.
Okay, I'm not getting a response, but if we do before we're done here, Mark, I'll break in. Okay.
I'll find a way to get to and put it in the show notes or whatever. Here's our Christmas
Okay.
countdown. Not going to spend a lot of time on it. We're running just a little bit long, and we do have a roundtable tonight. These were some of the finalists in the list. Algonquin Electric is an interesting study, but just a little bit crazy at this time. I just threw them on a dashboard, ranked them from highest return to lowest return forecast. I like some of the quality numbers up at the top. Some of these we had already committed. Went through a quick worksheet, decided to set Middleby and Shockwave aside. I love the Shockwave story. Fair amount of content going on at Manifest. The one thing that gives me a little bit of heartburn is the amount of discretionary stocks that are showing up here in the mix. We're going to talk more about the discretionary sector as an economic indicator, if not next week, the week after that. So that this is kind of a lead into a discussion. As the American consumer goes, so goes the economy and ultimately the stock market. It's really pretty straightforward. So this is what we end up with for our Christmas countdown. And those are all pretty good studies, many of them fairly current. I am scratching my head over MP materials for tonight. Not on this list, but there are several on this list which would be attractive possibly for tonight also. With that, we'll just close with our reminder that we do archive these sessions on YouTube. Please subscribe if you'd like to be notified anytime we add new content. Here are two books that have been recommended by Matt Spielman. I already have the top one and have taken a quick look at it. And the one at the bottom by Annie Duke, Thinking in Bets, also is pretty compelling. I like those two quotes. They're there on the right. So we will probably be, I think Ken, we need to get together and decide when we want to shoot for a discussion on this one.
Okay. And Mark, Joe's book is "The End of the World is Just the Beginning" by Peter Zeihan, Zeihan.
Okay, we'll look that up too. And so with that, the bull gets his annual Christmas decor, and he's definitely in Merry Christmas and Happy New Year spirit. Hopefully they'll tack 3 or 4% on the S&P 500, and we can move that bar on our histogram. But with that, Ken, anything else in the hopper, or should we get to work on tonight?
No, just I hope to see a lot of you with us this evening, and if not, Happy New Year to everybody, and we'll be with you again on January 3rd, I think the date is.
Okay. Take care, everybody.